Hey everybody, so I was there looking at these trannies the other day, and by trannies I mean transportations. The old name that's been around for a long time is trannies. What can I say? I don't make this stuff up. So here's a chart of the transportation index, or an ETF mimicking the transportation index. And what you can see is a monster double bottom, I'm sorry, not double bottom, head and shoulders bottom. And you can see we're just breaking out. This would suggest that we could see this market move all the way up to about 166. That would be about a 15% move over a fairly short period of time. So transportations or trannies look like they're starting to break out. In addition, look at the top panel there. That's the relationship of the IYT to the S&P. And you can see that it's been outperforming the S&P since August. Now, why is it important that trannies are so important? Trannies represent the transportation sector. If the economy is doing well, then transportation stocks has to be doing well. We can't be manufacturing goods and not transporting them. We can't be doing a lot of import and export without there being transportation. So one of the ways that we look at to understand what's going on in the economy is we look at the trannies to see how they're doing. You can see they've been sort of struggling, but we may be breaking out right now to the upside, thus suggesting that the economy is getting better and probably that the stock market's going to get better. Let's take a look at one of the leaders. This is Union Pacific. I don't want to buy it because it's not growing earnings fast enough, but this is showing the kind of strength that we're seeing. We're seeing we're seeing trains do well. We're seeing truckers do well. Airlines are starting to come back as well, up until the last few days when the price of oil jumped up. Hey everybody, this is Courtney Smith here with our weekly video newsletter, TradeSmith, bringing the hammer to the market for over 45 years. Oh, I don't look that old, do I? I hardly look 45 years old, for heaven's sakes. Okay, this disclaimer is definitely not 45 years old or as old as I am, but you should still look at it. Still very important. Let's take a look at the S&P 500. So I showed you the trannies. I showed you how they were breaking out. That would be bullish for the S&P 500. Right now, the S&P 500, I think we're going to get into seasonality in a second, but this market is holding up extremely well during a period of poor seasonality. I look at it this way. If there's bad news out there, like negative seasonality, and we're still holding up, as soon as that seasonality goes, this market's going to pop. So I'm turning more and more bullish as we hold our strength in the face of bearish seasonality. From a chart perspective, you can see that we're forming what's called an ascending triangle, a flat top and a slanted up bottom, and those are usually broken out in the direction of the slanted bottom, in other words, up. One of the big things that I've been concerned about has been the purple predictor, which had triggered and showed us the sell-off we were going to have. You can see it's moving higher. It's not being supportive. I'd love to see it catch up with the price action. We're still way below the price action, but at least we're not weaker than the price action, so that's good. Down at the bottom, the green arrow shows that this rally we've had over the last week is occurring on increasing volume. Increasing volume is a confirming indicator suggesting that the price action is good. So my bearishness on the market is evaporating as we're able to stay stable in the face of negative news. And now we're starting to see more and more positive things in the marketplace. Now, Dow, same thing, only not as strong. This is the NASDAQ, same thing, only stronger. This is where the action is. I've been telling you that for a long time. We made new highs a week ago. We haven't made new highs in the S&P and in the Dow. So remember, stay with these kind of stocks. Don't go with the S&P and Dow type stocks. Seasonality, our seasonality indicator, we're calling it neutral, but in a couple of weeks, the seasonality should turn bullish. And if we're still making higher highs and higher lows like we are now, then I'm going to turn our seasonality indicator into bullish. And that's important because it means then that there's not many things that are going to stop the market from going higher in the near future. And it means that we should increase the size of our positions. Should take more risk, make hay while the sun shines. Now, what's going to happen with the election? Well, let's go to the next chart. So here's the thing. What normally happens is the market rallies in the fourth quarter. Even if there's a presidential election, that would be the blue line, second from the high. You can see that the market usually rallies. But volatility goes up in the month of October. So we're going to see more volatile daily price action, weekly price action, and so on and so forth. So look for herky-jerky, but generally higher prices starting really pretty soon. All right. So the dip that we were looking for up here on this chart, if we use the blue line, be about a 4% dip. It looks like we've had that 4% dip. And now I'm not quite going to get super aggressive, but you're going to see me get more and more aggressive and get more and more long positions and get rid of our hedges as we move forward. Yield curve, still a bummer, but okay. Asset allocation, not really doing anything. Stock market risk indicator, man, that thing is flatlining. Global shares showing a similar situation to the U.S. shares, stable, but that's good in a bearish situation. So a bearish seasonality. Japanese shares are the place where I'm getting more and more bulled up. Now, why? I'm not ready to really be an aggressive buyer yet, but man, am I getting close. Let's take a look. First of all, we've got tremendous fundamentals. What do I mean by that? There's free money. There's free money in Japan. They're giving it away. They're handing out $20 bills on the street corner. Okay, I lied about that last part. But if you're a big bank, you can borrow money for nothing. And that means that a lot of that is going to go into the stock market. Number two, the Japanese central bank is buying stocks. They've basically run out of bonds to buy. There's no more bonds to buy. They've been doing quantitative easing in Japan for so long that there's no more bonds to buy. So guess what? That means they've got to go buy stocks, and they're now the largest buyer of stocks in Japan. So that's going to cause Japanese stocks to continue to move higher. Third factor, QE. They're going to continue to flood the economy with money. In addition, we're going to see more fiscal stimulus. Shinzo Abe's government is going to go out there and spend money like a drunken sailor. You watch it. A lot of that money's going to go into construction companies, banking companies, and that's going to boost their profitability. So this is going to be a choppy, sloppy move, but it's going to move it higher. The way to play it is either EWJ, or another great ETF is DXJ. Now the difference is that DXJ hedges out the US yen risk. So there's no currency risk with DXJ. EWJ includes the currency. So DXJ is a pure play on the Japanese stock market. Look to get long. Now, I don't want to get long right now, but soon. Why not? Look at the double red lines up top. It shows that the green RSI did not make a new high when the stock price made a new high. And as expected and as predicted, the stock market sold off. But it's got to be getting to an end of that little dip we've had over the last week and a half. So if we see any strength in this market at all, I'd be a buyer. Bonds, I was in bondage last week, totally enthralled by bonds. I'm still enthralled by them. This price action is like a textbook. First, we've got the box there. Well, first of all, we have the purple, the bottom purple line. That was support. It was broken. We gapped lower in the beginning of September. Then we made the big island reversal, which I put the box around, which we did that a week and a half ago. We rallied up to the broken uptrend line, and now we've sold off. Oh my God. Well, what's going to happen to bonds? Are we going to see bonds go up and yields down? Or are we going to see bonds go down and yields up? Let's go to our key indicators. They're suggesting lower interest rates. 2 out of 3 indicators are suggesting lower interest rates, and only one of them is suggesting sideways. So what does that mean? That means that this should go back up and break through the top side. I got to tell you, I am short and uncomfortable right now. Okay, let's look at the dollar. Dollar, I've been telling you, I don't want to trade this. Do I have to trade it? Do I have to have an opinion? Well, hey, nothing's ever stopped me from having an opinion, so let me give you one. I'm still bullish. I have no position. I don't care. I think there's better places to be. But we still have to look at the dollar, and we have to see that it's really in a trading range with a slight upward bias. Slight upward bias. So why is that important? Because it affects the price of gold, and it affects the price of oil, and it affects all these other things. So if we see the dollar with a slight upside bias, there's a pretty good chance we're going to see gold with a slight downside bias. And that's exactly what's happened here. Notice we have what's called a descending triangle. This is not normally a topping pattern, but it is bearish if we break that bottom horizontal line. At this point, I don't think we want to be involved in the gold market. If it breaks that 1310 level, probably want to be short. If it breaks the 1350 area, I'll probably go long. We need to monitor it closely because we're going to have a trade here in gold very soon. Normally, with the strong dollar, we should see gold go down. Gold is really effectively another currency, and it runs opposite to the price of the dollar. But the dollar's been boring, gold has become boring. Okay, our indicators are starting to build up a little bullishness. They were actually all negative 3 or 4 weeks ago. Then they went neutral. We're starting to get some slight upticks. That would suggest we're going to break the 1350 area, which would trigger me to get long. Now, oil. We've got this. This is another thing. One of the key things we need to do as traders is not trade sometimes. Sometimes we have to just sit on our hands and say, you know what? This is not an optimal time to be trading. We got to stand aside. Right now is a time when we should be trading the stock market. We should be trading the bond market. We should kind of skip some of these other markets. Oil had a descending triangle, but it broke to the upside. Normally, descending triangles break to the bottom. This one went upside. Where is it going to go? Probably up to the top of the formation at just above 49 bucks, about $1 higher than where we are now. I'm still bored out of my mind trading here. Best that I'm going to stand aside. But hey, you shouldn't stand aside if you're a freebie. No, you should subscribe. That would be the best thing for you, because then you would get those super cool stock and options recommendations, and you'd be making some money right now. Instead, you're sitting there in your pajamas. Oh, no, sorry. Okay, come on, guys. You should subscribe. Also coming up is our infamous Stock Success School. Go to that site. You can get some more information. It is the premier stock trading education, and it teaches the techniques that I largely used when I managed the #1 performing mutual fund in the United States. Check it out. I think you're going to like it. All right, freebies, love having you here. This is actually a pretty good market for us to trade in. It's turning more and more bullish all the time, which I like because we can make some good money on the upside. Some of these markets don't want to really trade much right now, like dollar, oil, not so good. But the stock market's really, really good for us right now. So we'll see you guys next week. Fully paid up members, hang in there for just a second, and we'll get into some specific recommendations and more in-depth analysis.